Okay, the time value of money, a dollar today is worth more than a dollar in the future, is important in accounting and probably the easiest place to begin to understand how time value of money fits into accounting is the area of asset retirement obligations. So if we have an asset and we have to fix something about it at the end of our use of it, that's called an asset retirement obligations. Common examples are decommissioning a nuclear power plant or repairing a gold mine after we're finished with it. So let's look at this in the context of an oil well. It could also be much more mundane. You might be renting a building, and at the end of the lease, you have to restore it to its original condition. But let's talk about an oil well today. So an asset retirement obligation means we have to fix some things or something when we're finished using the asset. And we look at the ASC, we look at the topic 420, subtopic 20, section 25, paragraph 4, and it says that we're supposed to recognize the fair value of liability for an asset retirement obligation in the period in which it's incurred. In other words, when we buy that asset, when we acquire that asset, we have to capitalize every penny that we incur to put that asset into place. That includes pennies that we're going to spend in the future. Okay, let's pretend we're going to buy an oil well for $750,000 cash. Well, when we're finished drilling, when we take out all the oil we think we're going to get, we're going to have to restore the land. So we'll mine this thing for 10 years, and then we'll have an asset retirement obligation at the end of 10 years. So if we just cleaned up an oil well just like this and it cost us $100,000, that would be a level 1 estimate of fair value. If we didn't do one just like it, but we just did a couple that were very similar, then this $100,000, we'd call that a level 2. If we never ever had dismantled an oil rig before and restored the land, then that would be called a level 3. We'd have to make kind of a guess at how much it's going to cost us. So what we're going to need to do is include that $100,000 asset retirement obligation as part of the cost of our original acquisition of the asset, but at its present value, its value today. Let's assume the appropriate discount rate is 8%. We'll have to find the present value of $100,000 10 years from now using an 8% discount rate. Now we could use algebra. We could take $100,000 over 1 plus 0.08 raised to the 10th power, or we could use our calculator. So since there's no payment in the meantime that's changing, we can use the third row of our calculator. So let's hit second FV. That actually accesses second clear time value menu. And we can put these factors in any order, but let's go from left to right. What's the N? What's the number of period? Well, it's 10 years. If 8% is the appropriate discount rate, that we put in 8 as the periodic interest rate. PV is what we're trying to solve for. There's no payment in the meantime being made, but there is a lump sum of $100,000 due in the future. So we'll plug in $100,000 future value, and we'll hit compute PV, and we'll get $46,319.35. And we won't be bothered by this minus sign because that's just a calculator convention. If you plug in positive numbers down here in the third row, it'll spit out a negative number. The present value of $100,000 obligation 10 years from now is $46,319.35. So what do those journal entries look like? Because life is only understood in terms of debits and credits. We'll debit oil platform or oil drilling rig or whatever we want to call it, the asset for $750,000 or credit cash for $750,000. And now we also have to include that asset retirement obligation at its fair value, which in this case means its present value. So we'll credit this obligation. This is a liability account for $46,319. And we'll debit oil platform for $46,319. So our total cost for this oil platform is $796,319, and that's the number we'll use to calculate depletion. Remember, depletion is just like depreciation, except it's the word we use when we're dealing with natural resources. So let's get a little ahead of ourselves. How do we get this $46,319 to be $100,000 at year 10? We don't want to credit this guy here and debit oil platform, because then we'd have to recalculate our depletion rate every year based on the increased value of the oil platform. So what we're going to do is we're going to increase this and debit an account called either interest expense or accretion expense. So after 1 year goes by, we're going to figure out the balance in this account and add 8% interest. Another way to think about present value is it takes the interest out of the transaction. So when we found the present value of that $100,000 to be $46,319, we actually took the interest out, and now we're going to put the interest back in. So we multiply 46,319 times 8%. We get 3,706 of accretion expense, and we credit asset retirement obligation for that 3,706. Then at the end of year 2, we take 46,319 plus 3,706. We get a balance in that account of $50,025. We add 8% interest on by debiting accretion expense for $4,002 and crediting asset retirement obligation for $4,002. And we do that every year until we get to year 10. And as you can see, since we're adding interest on top of interest, it's a compound interest situation, interest is getting a little bit larger every year. And at the end of year 10, that asset retirement obligation has its predicted value of $100,000. So if we repair it for $100,000, we debit asset retirement obligation for $100,000 and credit cash for $100,000. If it only costs us $95,000, we have a $5,000 gain. If it costs us $105,000, we have a $5,000 loss. And that's all there is to asset retirement obligations.